Hello, Greg Kuda.
Hey, Mike, how are you?
I'm doing pretty good, man. Busy day today, I'm sure.
Yeah. I'm not gonna. I'll have like a half hour. I barely got this done. It's gonna be mostly. I didn't even look at the other stuff. It's just gonna be mostly lumber here.
Okay, perfect. No worries.
Let me share my screen. There we go. Share. Yeah. No, just uh, good volume. You see that? We're good.
Yep, we're all good.
So yeah, no, lumber's up hard. We've traded limit up today. There was a pull, so Howe's limit is in play. Our last trade 458.80 up 23.90 in March. May is limit bid right now. So just like that, we're kind of back to our old ways here. There were, I'm not sure. Obviously it's probably all of the above. Sinclair had announced a shutdown, a 2-week shutdown at some of their stud mills,
Okay,
and then Tulco announced a continuation out of 2 stud mills for February.
correct.
So I think that kind of gave the market its up move on the opening, and then kind of add the funds, and here we are.
Yeah, and I know we're gonna go over that fun stuff as well. Fund stuff.
Yeah, no, it's
Um,
it's uh, uh, it's sad that they're exiting stage left. We're reverting back to lumber, the old ways of lumber here. But let me. So, the thing I want to point out here is, and you'll see this, is that as the dollar stumbles around, and this doesn't kind of give you a reference point, but the dollar had gotten up to 114 as the high water mark on the dollar index. The dollar today is a 101. So as the dollar continues to go sideways and weaken, it becomes game on for U.S. dollar denominated commodities. And when you look at, gold, copper, crude oil, lumber, uh, even wheat, but when you look at year-to-date returns, okay, the dollar is off dramatically from its high water mark. So the beneficiary, Bitcoin, I'm not going to even begin to understand Bitcoin here, but lumber, real commodities, and I'm sorry if I offended any Bitcoin traders, but real commodities, year to date, lumber's up 19%. Aluminum, high grade copper, obviously you have the NASDAQ, which is interesting into itself, and that Nasdaq is rallying off of everybody getting laid off in tech world.
well, it
You know,
makes sense. The economy is definitely slowing. There's not going to be the growth. These companies
yeah.
need to trim.
Well, and again, the market likes layoffs because you're cutting overhead. Um, and then look at RBOB, gasoline's up 7%, gold's up 5.9%. So you have this resurgence of physical commodities, lumber leading the pack, where as much as I want to say the rationale behind the funds exiting their short position, when you look at an aggregate basket of commodities, the funds have been on a buying spree in pretty much every physical commodity that's dollar denominated, lumber included. So, when you look at 5-day returns here, again, heating oil's up 6%. Lumber's up just under 6%, over 6% after today's gains. RBOB, platinum. So this will be interesting from an inflationary standpoint as we start to see the inflation metrics come back down to reality. The what if scenario if commodities continue to push higher here, and I think a lot of this rally, more so than anything, any significant changes in the US or Europe, this is really predicated on the idea that China's back online
Yep.
and going to be a normal consumer of physical commodities. So that's the beneficiary, that's the tailwind behind commodities right now, this kind of flight to quality that China's back on. So, the idea that inflation, yeah, it's showing signs of normalcy, but it'll be interesting to see, if you continue to get this appreciation in physical commodities, what that ultimately means for inflationary numbers down the road. But I don't want to, like I said, I don't have much in the way of anything else. I just have lumber today, just because of just the busyness of today and the time constraints. So when
Well,
we look at, yeah, I'm
let's
sorry,
still
go ahead,
just
Mike.
jump back to the dollar real quick and how it actually affects us as lumber folk. The Europeans, the euro was par and maybe almost under a little bit. Well, back think November, October, it's 110 now. That's a 10% jump. That's a
Right.
10% reduction in what the Europeans are getting back. So I've talked to a couple of European sawmills.
And Mike, just so everybody gets an idea, so here's September, October. You can see the dollar trades up into the 114 area, and now we're back near parity. And I'll pull up. Let me pull up a euro chart here. So same thing with the euro. You can see back in September, October, the euro actually trades at a discount to the dollar. And look at where the euro is back up to 110 now. So this is exactly what you're, here's your graphical representation of what's going on with the euro right now.
And it's not just euro. I mean, the Mexican peso.
Right.
I booked a vacation for spring break in Mexico, and it's higher now, all because of taxes and fees and the exchange rate.
Yeah, and when you go back to again, year-to-date returns, you can see here's your Mexican peso up 4% on the year, the Brazilian real up 4%, Aussie. Let me just see, got it on another screen here. Euro, just so people Euro's up only just under 1% for the year, but off of that low water mark back in September, October of last year, you're up substantially off of that low water mark.
Yep, for sure. All right. Lumber.
Yeah, lumber. So last week we had Jan expiration at 344. And of course, the market, just kind of ignores the weakness of Jan, ignores the weakness of today, and seems to fixate more on the what-if scenario, especially related to the commodity funds exiting their short position. So that is the 800-pound gorilla in the room. Commodity funds are just exiting stage left.
Did you have more slides to show, or was that it?
I'm sorry. Did I stop sharing?
Yeah.
No, I'm sorry. Hang on 1 second.
People would rather look at slides than our mug.
Yeah. No, I get that. Sorry. Okay. I'm sorry. Do you have it or no? Oh, there we go. Okay.
Perfect. Okay.
Now we're good. Okay. So I'm sorry. This is a weekly continuation. And so here's January expiration last week at 344. You've had this resurgence, and we'll look at some other charts here that kind of show technically what's going on. But the market right now is more fixated on commodity fund short liquidation and the what ifs with the continuation of curtailments coming out of BC. And so of interest today, we traded, obviously limit up in this 458.90. So the significance of that today, Mike, is that we filled the November expiration gap of 454.80.
Okay.
And now that sets up the potential to go fill the September expiration gap of 483.50. So that's kind of where you're at. And then when you look at, here's a weekly continuation blown up, you're kind of back above the 18 period, the 18 week right now. And so when you do Fibonacci retracements, it sets up, I didn't put both bands because it had just been too much, I didn't put both Fibonacci's, but basically this 460 area is also let's call it a 465, 475, 480 up through the 500, 525 area. You have 62% retracements if you take this high right here. And then if you go back and take this actual high back in July, then here's your 62% retracement. Yeah. So technically, you certainly, as long as you stay above here and, you have the potential to get back to higher numbers. And I'll come back to this. Let's skip over that. But here's kind of what you're looking at today. So here's a March daily chart. You're into the Bollinger Band high. You filled that continuation gap at 454.80. And then you have the 100-day moving average right here. So does this become the catalyst in trading up to the 100-day to see new buying, to see a continuation of more short covering? Because, you know, as and we'll look at this and come back to this, but I just want to jump to open interest. So this is open interest a week ago. We were at 28.56. And so if you remember, the high water mark was around 3,200. A week ago, we were 28.56. And when you look at today, fast forward here, we're down to 25.76. So we're just seeing this big liquidation right now. Sorry about that. We're just seeing a big liquidation right now. And if I'm a betting man, unfortunately, if we're going to go back to just being the same old lumber, you could see total open interest drop down into this 2,200 to 2,000 area, because the reality is and we'll look at the CFTC numbers. So this was 2 weeks ago. You were up to 1955 managed money shorts. The commodity fund longs were 209. If you fast forward, and this is as of last Tuesday, you liquidated 722 shorts. My guess is, as of today, this number is well under 1,000. You could be in the 800 to 700 area or lower. This long managed money long position is probably 400 to 500. So we knew all along, and I'll go back here, we had this massive disparity between managed money shorts versus managed money longs. So as you beat these guys out of the market, you're replacing them with momentum longs. You're seeing a liquidation of producer longs and an increase in producer shorts. So again, this is as of last Friday. You can see that, you can see that longs now have liquidated 231. Commercial shorts have increased. You're getting long managed money longs increasing. But the big, again, for every 3 contracts you're losing, you're only picking up a contract. So the net result is this big liquidation of open interest. And that's where you're seeing it here, where again, the high water mark was 3,200 open interest. You're back down to 25.76. The reality is, with this continued liquidation of these guys, again, you're not replacing one-to-one now with these longs or these shorts. So the reality is, this open interest probably comes down to 2,200 to 2,000 on this move.
But as we go higher, then the interest in the industry to get short grows.
Yeah.
So
so the critical thing here, this is your ultimate bear market rally. I mean, this is a textbook bear market rally where you get some kind of supply constraint, you get some kind of extraneous event like commodity funds. There's nothing to do with seemingly with lumber or the fundamentals of lumber. The funds just want it out. We can kind of speculate why they want it out. The winds have shifted in housing, blah, blah, blah. But when you look at the other commodities, they're getting out of lumber because they're buying physical commodities right now. Pure and simple, just look at those other commodities we referenced earlier. The funds are in buying. So that's something to watch. How much are people going to chase? And so, like what you'd want to see to support these higher numbers in futures, you definitely want to see a build in open interest. Again, if the move is we're just going to beat those commodity fund shorts out of the market, you're going to get momentum longs that chase. So you are getting new fund longs buying. But at the end of this, if the fundamentals don't rise up to support this in the form of cash, then you take the shorts out. The second the momentum stalls to the upside, you probably race right back down and take those longs out. And you see this bigger reset of 2,200 to 2,000. That's kind of a worst case scenario, what I see with open interest. If we're just beating people out of this market and nothing is fundamentally changed, then open interest, you go from 3,200, you give up 1,000 contracts when this resets.
And I mean, I could build the case that as we go higher, we start to pick up open interest.
And that's my yeah, absolutely. I mean, that's fingers crossed. I mean, that's the hope that you do to start to see open interest stabilize and build back up toward 3,000, because that makes again, I apologize for jumping around like this, but my head and thoughts are racing a mile a minute. That makes this rally much more sustainable if cash can get dragged up with it, and you ultimately convince people that fundamentally there's value at these numbers to ultimately, again, this is the 100-day. So can you go back to the 200-day? Can you go back and fill these gaps back in the 500 area? You want to see open interest. If you're going to continue to push higher, you want to see the open interest build to support that, because that tells you that people fundamentally, there's this shift in sentiment that the fundamentals have changed to support chasing a higher high move in lumber and prove that this isn't just a bear market rally. Because if this is just a bear market rally, you're going to get the Eiffel Tower where you spike to the upside violently and then you come crashing back down violently back to the downside.
I think that the temperament of the demand side going through these last years will be, okay, let's take a look at this. I understand these prices are elevated off a historic low of historic prices. There's so much lower than we have been in the previous 2 years. I think demand could step in at these higher levels.
Yeah, and so again, when you look at people do know that I'm on this podcast, believe it or not, with my phone ringing there. So when you look at the seasonality, again, this is your 3-year, 5-year average. So how realistic are these highs? Like you factor in the last 2 years, we have this preconceived notion that the volatility has to be higher, that we have to move around in $300 to $500 price bands. That's what the last 2 years have conditioned us. But again, when you take out the last 2 years, you're in the middle of what you typically historically do here. So that's the big reset here. Does the last 2 years mean anything moving forward? Are we meant to move around in bigger price trading ranges, $300 to $500 limits, or is this a reversion back to pre-COVID type levels where, again, when you take out the last 2 years, again, here's this chart factoring in the last 2 years. Does this mean anything, or what is this trying to tell us? Because if we ignore the last 2 years, you're back into the normalcy of lumber. If the last 2 years mean anything, then you still have all this upside potential.
Well, look, I think we can kind of sum this whole thing up. The reality is, it's the funds buying back their positions that triggered this whole thing going on.
Yeah.
They are going to continue to do that as we move higher. If we don't move higher, if we pause and move lower, then they may add back in or do nothing. But as of right now, every time we go up, there's more incentive to continue that move higher. And Kyle Little, is sitting here saying, what a setup. And he, says it well. You buy at the bottom quartile of absolute prices, and you can basis trade, sell a futures against it at a ridiculous wide margin.
Yeah, and again, thanks for watching, Kyle. Here's the basis, and I agree. And we've talked about basis, and we've had people reach out to us about the basis, and you need to factor in the cost of carry. You need to factor in how and when it ships. You need to factor in the cost of money. But just remember, you have historically wide basis opportunities right now, and that if this was a normal basis right now, with March at $458, cash should be about $435. Obviously, it's not. When you look at the mills, Fraser was up today $10 out of the south. They're at 374. Canfor was a 365. Fraser had wood for next week. Canfor has wood out of Alberta the middle of February. So obviously cash on a 2x4 basis. And again, we're looking at legacy futures. This is a Western 2x4 market here. You have a substantial basis opportunity, but again, that basis, that convergence, this is the critical thing with basis. You can't have ulterior motives in what you think basis should do. That's speculation. The basis ultimately will converge in on itself. We don't know, does cash have to come up to futures? Does futures have to come back down to cash? If the answer is, well, I think that cash has to do this or futures has to do that, that's speculation. That's not a basis. You're speculating on the basis. All you care about is that if you're going to sell futures and you have a substantially higher move in futures relative to what cash has done here, you have to be able to margin call the futures and live with the consequences of this basis might not converge. You might not, you're at $75, $80 basis. You might not get this basis convergence for a month from now. You might not get it until the third week of February. You might not get it until you're closer to the spot month of March. So that's the risk of basis. You have to understand that the convergence will ultimately take place, but the speculative element is that one side has to do this or the other. All you're trying to do as a basis trader is capture this. You've got this divergence. You're just trying to capture that divergence in being a basis trader.
And if anyone has questions about it, obviously ask us. But I couldn't recommend. If now's the time to try this, if there ever was, because you can really screw up pretty badly and still do all right with this particular.
Yeah, and so then the other thing, we do extensive correlation studies where what items do you specifically trade? Is it all Western SPF? Is it Euro? Is it Great Lakes? Is it Eastern? Is it hemp fur, Doug fur? Are you into MSR? Are you into wides, narrows, where you really have to do the correlation to understand the basis of what you're actually trading, what you're actually putting into your yard, to understand those historical correlation relationships. And that's where there's the blanket approaches do not work with basis trading. It has to be very specific to what you're trying to accomplish. Are you buying mill direct wood? Are you buying from wholesalers? Are you buying trucks? Are you buying cars? All these things get factored in, baked into the cake as far as basis trading.
Yep, for sure. All right. I think you got to get hopping, right?
Yeah, let me just see if there's so here's this is just so people can see weekly basis. So this is just random lengths, 2x4 prices against Western SPF 2x4 prices. Okay, here's your basis. You can see you kind of chop around 25 over to really call it 35 under since the beginning of time. And when you look at this basis goes all the way back. I have data on this back into, I think, 1992. And so you start to get these aberrations with the pandemic. And so now, historically speaking, you were at a very wide, even if you take out the last 2 years, you're at a very wide differential. This 2018 time period is when we spiked up to 659. So again, can basis go wider? Yeah, well, absolutely. But why are you doing and what are you trying to accomplish? These are all critical questions in order for it to work.
Love it.
And then just Brian McFarland, Volume and Open Interest Theory by Ken Shalin.
That's a great read.
Yeah. Actually, and again, price up, volume down, open interest down, not bullish. Absolutely. This is a bear market rally. Until you get the build and open interest, this is bear market rally 101.
Oh, absolutely. This is classic. Someone's being forced. It is a short squeeze.
I think that was it. You know, we'll kind of hopefully get more of a resumption of a normal show. But again, you know, as much as it's important to watch lumber, I'm watching the other commodities because the funds have been on a buying spree in just about every other physical commodity, or at least in the precious metals and the energies complex. So, you know, obviously you've had spillover into lumber as a result. So, you know, as those markets potentially top out, I would watch crude oil here. I would watch gold. If they start to give signs of a top, then you could see that spill over with the funds into lumber as well.
Perfect. All right. All right, everyone. We're going to see you next week. We're going to have some of the funds starting their roll at the end of the week.
Oh yeah, and I forgot, Mike, to reference this, and I don't have it up, but the Rogers Fund. So Jim Rogers, Beeland, he's the original. He's like the OG of commodity funds. He's the original commodity fund guy. He was based out of Chicago. I think he lives in Singapore now. But Rogers Fund is the original fund that started to trade lumber futures back in 2004, 2005. They've always maintained some kind of weighting in lumber futures, and at their last meeting, they referenced the fact that they will roll their legacy futures position into the mini contract. They have no problem trading the mini, and they will support the mini contract. So I would expect this. A lot of funds trade off of what Rogers does. So this is a very good thing for that mini truck-based contract. The fact that Rogers Fund will support it.
Perfect. All right, everyone. With that being said, we're going to tune out. Catch you guys next week. Basis trade opportunity is still there. Futures is leading the charge. Cash market is seeing some curtailment. I don't want to say that we're underbought, but one of the interesting things, and we referenced it last week, we're finishing a lot of houses right now. Like, we are really being very efficient with our building. Is that going to carry over into Q1, Q2 of this year? Well, I guess we're already in Q2 of this year.
And Mike, a shameless plug here. Hopefully get some better insight on that. I will be at the IBS show next week. That's in Las Vegas. It's the big home builder show. So if anybody's going to be out there, home builders, I'd love to sit down and talk to you. Alex and I would love to meet you. We'll be out there to try to get a lay of the land and get a better comprehension with the home builder component, both single and family, because that's the big home builder show for the year.
Perfect. All right, cool. When are you heading out for that?
You know what? That's a good question. I think either early next week. I'll let you know.
Okay, perfect. All right, sounds good. Thank you very much, and we'll see everybody next week.
Thanks, everybody. Thanks, Mike.